So far, October hasn't exactly been a glamorous month, unless you've been holding AMD, which is up nearly 50%. But if we zoom out over the past 12 months, nearly every major stock is up at least double digits. Now, with earnings season kicking off, volatility is almost guaranteed. But the real question is, which way will the market swing? And that is why today's episode we're focusing on 5 stocks that look strong heading into their earnings report. But let's be very clear, investor sentiment is still sitting in fear, and for good reason. We've got US-China tensions that haven't fully cooled. Some are saying that China in fact have the upper hand, whilst others believe that Donald Trump is best positioned to secure the best deal for the USA, but only time will tell. We also have expected rate cuts market is pricing in to before the year end, and of course we've got the ongoing government shutdown drama where nobody really knows when it'll end. Yesterday, also worth highlighting, Amazon briefly took down half the internet, a reminder of how crucial this company is. And despite that, just want you to understand this is a company that has quadrupled its operating income in just the last 2 years. The share price has only doubled, making it, as we've done in our deeper dive, a very strong buy in this current climate. And for those that don't know, Amazon does have many strong brands, of which you'll know most of these under their umbrella. So with that said, let's dive into the 5 stocks we believe are positioned to outperform as earnings season heats up. Now the first one is S&P Global, where for each company we'll run it through our own valuation model. We'll look at the blue tunnel as well as understanding how strong have they been in their previous earnings. Now this one is down 9% in the last year, year to date down 4%, over the last 10, massive outperformance of the S&P, up 416%, and they are trading more towards the lower end of the 52-week range. Respectable buy rating from Seeking Alpha, maybe 4 out of 5, but Wall Street themselves have a strong buy rating, 4.7 out of 5. And when we do take a look, forward valuation of 26, one of the lowest it's been in the last 5 years, is also below their historical average of 30. That, as we always say, at a glance, does mean potential undervaluation, not something that we look in pure isolation, which when we do take a look at the blue tunnel, and we have to state for the newer viewers, effectively within the parameters, the upper and lower bound does signal the expected or intrinsic price. Today, as it has done in the last few days, sits just below that, which does give us a sense of potential undervaluation. The other time we saw this in the last year was during Liberation Day, and if we zoom out to the last 5 years, a very clear picture that this one rarely, if ever at all, does give investors the chance to buy this in a severely undervalued position, meaning the market does consider this a high quality company. And we'll zoom out even further to the last 10 years. Again, the conclusion does remain. This is one that is high quality in terms of what the market believes, and great to see the intrinsic price, the blue tunnel, increasing over time. Not something we see with every company, and they are due to report their earnings on the 30th of this month before the market open, so we're talking just over a week. Where in their previous earnings, it wasn't anything too special. We saw the top line was up 6% from the same quarter last year. We did like EPS up double digit, that was in fact 10%, and also something we talk about a lot on this channel. Yes, we love it when companies increase their top line, but a criteria for a high quality company is also efficiencies to their margin, which, although it was small, was an increase from 50.7% to 51.4%, and they're projecting the next 4 quarters to be double-digit growth. Great to see. 100% track record, even better, 4 out of 4 beats, giving us faith they can hit their next year full accounting earnings per share target, lowering the forward P to 24.6, where for each one of these companies, as we said, we'll highlight their performance going back to the last 2 years. So in essence, we're looking at the last 8 quarters. Well, earnings per share, 7 out of 8 beats. They only missed on one occasion. Revenue, again, 7 out of 8. This really highlights this company, more often than not, does typically outperform. And if we were to take a look and stretch back to 2009, well, they only missed on two. The most recent one was a very marginal miss on the earnings per share. They reported $12.60. The estimate was $12.61. This is definitely a good look in terms of management and how accurate they are. Hopefully we get to see another beat in the earnings in the next few weeks. In terms of revenue, when we go back to 2009, one additional miss, but we can in fact see, if you want to see the most recent one, 2018, 6.26 billion reported, estimate was 6.33. Again, another indication for S&P Global that they are more often than not very consistent and do slightly outperform. And in terms of their growth, they get a C+. Now we noticed revenue was up 11% last year. They're expecting just below that for this 2026 period. In terms of the sector, they are reporting revenue slightly above, but historically they have grown their revenue based on the 5-year average a little bit higher. Earnings per share as well projected 11% over the next 3 to 5 years, in line with the sector, but again, like revenue, slightly below their own 5-year average. And profitability, also another important factor here. Gross margin 70%, above the sector at 60%, pretty much in line with their 5-year, so no efficiencies noted on that front. Net margin 27-28%, better than the sector, but a little bit below their 5-year. Ideally, we do want to see an improvement to their bottom line. Great thing to note though, their cash they generate from operations of $5.6 billion is significantly higher than their 5-year average at $3.8. And finally, before we jump into our own valuation, the institutional ownership of 87% highlights that $12 billion worth of shares was sold in the last year. A lot more buying, nearly double at $21 billion. And whilst we're waiting for the full data set for Q3, we can see already more buys than sells. If you wanted the reverse of the trend, where in fact they sold more than they did buy, well, you would have to go and only buy a marginal amount to Q1 2024, highlighting SPGI is an institutional favorite. As we flagged at the beginning, each one we're going to run through our own valuation, where for S&P Global, $647 derived from the DCF model. Now you see we've used a growth rate of 12%. We have a low, medium and high, 10, 12, 14 respectively. And as always, numbers here, they're subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, S&P Global or any others. One of the most important things here is, what does the reverse DCF highlight? Well, it's saying if you're buying around the market price today, 8% is baked into the growth moving forwards. Already tells you whether you see this as potentially under or overvalued. Do you believe this is too high? Then overvalued. Do you believe this is too low? Then potential undervaluation. So we get the growth rate as well as the discount rate, which gives us the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, giving us 647, indicating 35% upside. Now you may look at this and say that is too high, too optimistic. Well, look, at 10%, 557 indicating 17% upside, and if we go to 14%, 750, 57. But as always, we like to take through the middle rate where we're not done there, because we kick things off with a margin of safety. Ideally 10% execute buy if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data, making it buy at $583. Well, look, already this is highlighting you are getting a 26% margin of safety today if you believe the growth rate of 12% is in fact reasonable. Wall Street themselves, very bullish. We saw a strong buy, 620 into next year. That is upside of 30%. Now, maybe you look at this and you say it's too, in fact, optimistic. Well, at 10%, you are noticing it still flags undervaluation. You are getting a 14% margin of safety. So let us know your views on stock number 1, S&P Global. Is this, as Wall Street have flagged, a strong buy, or maybe you believe a hold or complete avoid? Before we move on to the next stock, just to let you know, we have released our latest free weekly article. We do on every single Sunday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is Intuit, up 8% in the last year. Year to date, up only 6%. Over the last 10, another outperform of the S&P, again trading around the mid to lower end of the 52-week range. Whilst we note a hold from Seeking Alpha and Quant, Wall Street buy 4.3, close to the 4.5 like we saw from S&P Global, to flip this into the strong buy rating. And we also note a potential undervaluation signal, forward PE 28.8 below historical 33.6. In fact, in 2022, this was selling at a forward valuation above the 60 mark. And we also get that undervalued signal on the blue tunnel where it is trading below the bottom end, something we have seen actually quite a few times in 2025. And zooming out to the last 5 years, again, this company actually goes through periods where it does trade at a discount overall, something we are seeing again today. And they're actually due to report their earnings next month, the 28th of November, after market close. And they did just fully report their FY25, where we can see their top line was up 16% year on year. Largest growth driver was in fact their Credit Karma, up 32%. And we can see efficiencies noted, although trivial, still nice to note. 1 percentage point on the gross profit, 4 on the operating side, and 2 on the bottom line net income. And they also project double-digit growth to the EPS in the next 4 quarters, 100% historical track record, at least in the last 4, where if they do hit their next full accounting period earnings per share, forward P lowers to 25.2. Now they have a phenomenal previous performance where over the last 2 years they've outperformed every single time on earnings per share, outperformed every single time as well when we're covering the revenue. And if we want to actually go back to 2010, well, we can note they have missed, although slightly, 2 times. The most recent one for earnings per share was July 2014. If we do the exact same for revenue, if we go back to the same time frame, well, they also missed twice. Most recent one, 2015. We would say a very, very consistent company. Growth gets a C. Top line revenue up 16% last year, projected 13 to 14 this year. Nice to note though, well above the sector in the mid to high single digit. Slower though than their historical 5-year average. Earnings per share, pretty similar story, 13 to 14%, but actually marginally below the sector, and also a little bit below 5-year of 16.4. Profitability strong at an A+, gross margin 80%, well above the sector at 50%, only slightly below their 5-year, so pretty consistent. Bottom line though, 21%, well above the sector at 5%, and also improvement to their historical 19%. Cash from operations also strong, 6.2 billion, well above their 5-year at 4.3, so they are generating more and more cash as the years go on. And institutions, with their 84% ownership, they sold 17 billion in the last year, bought a lot more at 28, and we can also see net buys quite strongly in the most recent quarter, nearly 1 billion buys versus 62 million selling. If you wanted the reverse of the trend, well, Q1 2024. Now, our intrinsic value just below $800 is derived using a growth rate of 12%, below both average of 24 and the most recent one of 30%, where baked in the reverse DCF is below 10%. Now, using the middle rate, you are getting a margin of safety today, 17%. If you want a 20, well, a buy at 638. If you want a 25, a buy at 598. With Wall Street themselves seeing 830 into next year, 25% upside. So do let us know your views, but we can also highlight on the 2 different scenarios. At the lower end of 10%, you are still getting a margin of safety, although trivial at the 4% point. And if you disagree and believe they can increase it 14% moving forwards, then you're looking at a 28% MOS. But let us know your views on Intuit today. We then move on to the Walt Disney Company, one we haven't covered in quite some time, up 16% in the last year, pretty much flat year to date. Over the last 10 years, it is actually down around 2%. All-time highs, you'd have to go to March 2021, just below $200. As of today though, trading towards the upper end of the 52-week range. Strong buy from Quant, near strong buy from Wall Street, although a fairly weak buy rating from Seeking Alpha. And we also note forward P of 18 is below the 5-year of 22, so already starting off with a potentially undervalued signal. And that also confirms when we look at the blue tunnel, although pretty much over the last 12 months consistently been below the bottom end of the intrinsic price. And if we zoom out to the last 5 years, well, there are a few different stories here. We can note this one was trading significantly above, in fact huge premium during the COVID era, and then it did in fact decrease quite sharply, where today we are seeing this at an undervalued level. Hasn't consistently been in the reasonable signal for quite some time, does just highlight how the market views the company. And they're reporting on the 13th of November before the market opened. Now we can see their latest quarter revenue was only up around 2% from the same quarter last year. We see their networks, that was actually hit quite substantially, down 15%, with the largest driver in fact being the Parkston experience, up around 9%. And they only expect 2 of the next 4 quarters to be growth. In fact, Q4 25 and Q1 26 pretty much down, although 100% track record, so we may see beats. It may actually turn positive with the next full accounting period, giving this a forward P of 17.3, and they've actually been quite inconsistent in terms of their performance, unlike the previous 2 companies. 4 earnings per share beats in the last 2 years, likewise 4 misses. Revenue not the greatest, 3 beats with 5 misses, may not give a lot of confidence, but if we do just take a look at their most recent misses, well, they were substantial. September 2022, 380 was expected, 353 was what they reported, and in fact, September 2021, 248 estimated, 233 actual. Something to bear in mind, and when we do take a look at the revenue, likewise, not the greatest. If we take a look at their most recent miss, September 2023, 89.08 billion estimated, coming in under at 88.9. Not the largest miss, although we did see 1.71 billion miss in September 2022, so something just to consider. Now growth comes in at a C, where it was up 5% last year, 4 to 5% expected this year, only marginally above the sector, and also not too dissimilar from their own historical values. Earnings per share projected 12.3%, pretty much in line with the sector, but historically this was up around 22%. Profitability with an A+, gross margin 38%, that is below the sector at 54%, but above quite significantly their 5-year average, which is good to see. Net income margin 12%, very good considering the sector sits below at 4% and even does their 5-year average. So actually we're seeing them become a lot more efficient in the last 5 years, and that also translates itself to the cash they're generating below 20 billion when historically it's been at 9.2. Institutions with their 66% ownership selling 14.5 billion, they bought around twice as much in the same time frame. Little bit indifferent when we look at Q3, only a very small amount of sales more than buys. If we want to see another time, well, Q1 2024. Now our intrinsic value, $134, is derived using a growth rate of 10%. Baked in today is 7.8, and we can see in the last 2 years their free cash flow has really been ramping up. Using that middle rate though, we do get upside of 20%, and that in turn gives us a margin of safety of 16%. You want 20, well, a buy at 107. You want 25, a buy at the $100 mark. Wall Street fairly bullish. They see this at 142 into next year. That is 27% upside. Now we will flag, if you want to see this at the higher end of 12%, then you are looking at a 29% MOS, but this seems to be a company that people either really like or really do completely avoid, so let us know your thoughts. The next one is Waste Management, which is up 2% in the last year. Year to date up 7%, over the last 10 up 300%, trading towards the lower end of the 52-week range. A double hold from Seeking Alpha and Quant. Wall Street buy rating 4 out of 5, where we notice the forward P pretty much in line with the 5-year average around the 27 mark. Same goes for the yield at 1.5. And when we take a look at the blue tunnel, this one has been reasonably valued over the last year. But what makes this very fascinating, in fact, to note, is that even when we zoom out to the last 5 years, this one has never been below the bottom end. Very fascinating to see. In fact, there was a period around 2020 to 2022 where this was trading at a premium. And if we zoom out the last 10 years, the conclusion remains to hold true. In fact, this one has never traded in a severely undervalued level. Definitely highlights the market believes Waste Management is a very high quality company, and they're due to report their earnings on the 27th of October after the market close. Now, their most recent earnings were fairly strong as well. We saw earnings per share 192, in fact from the same quarter last year 182. Bottom line also up to 777 million from 732, as well as top line 6.4 billion, previous sitting at 5.4, and they're projecting 3 of the next 4 quarters to be double-digit growth, 75% track record, and if they hit the EPS for December 26, well, forward P comes to 25.5, and their track record is also a little bit questionable. 5 out of 8 beats on the earnings per share. That is also reflected when we take a look at revenue, and if we look at their most recent earnings per share miss, well, it was in fact December 2024, where they missed by around 9 cents. In fact, we can see there has been a handful of times where since 2009 they have missed on earnings per share. If we have a quick look for revenue, pretty much conclusion is the same. Most recent, they also missed on the revenue, although it was fairly trivial, around 30 million, which also seems to be the case for their previous misses. We're not talking anything large, in fact, the negative 1%. So if we look at their growth, it does come to a C. Top line up 14% last year, projected around 10 this year, which is significantly above the sector, little bit above as well their own 5-year average. Earnings per share pretty much in line with both sector at 11% and their own historical, again the same figure. And profitability looking strong at an A+, gross margin 40% above the sector at 31, little improvement to their 5-year of 38. Bottom line, again the same conclusion, 11.4 above the sector at 6, above their 5-year of 11.1, and cash generated from operations. Good to see, something always worth checking, that companies are generating more and more cash as time goes on. And institutions with their 80% ownership sold 7 billion in the last year, buying nearly twice as much, buying a lot more again in Q3, so great to note. If you wanted the reverse of the trend, well, in fact, have to go quite some time to Q4 2022. In our intrinsic value, $207, we're actually solely looking at the DCF. It does come in quite some way lower. We've used 12% moving forwards. That is above the average, lower than 2024, baked in fairly high, solely using this model at 16.3, where actually we're not seeing a margin of safety, but in fact a premium around 4%. As we highlighted though, this is one that does look to always trade either at a reasonable price or at a bit of a premium. 10% MOS by 186, at 20, 166, and 25, 155. Wall Street like this, they see 262 into next year, 22% upside, but let us know your thoughts on Waste Management. We then move into the railroad industry with Canadian Pacific Kansas City Limited down 3% in the last year, up 5% year to date. Over the last 10, it has marginally outperformed the S&P, up 172, trading around the midpoint of the 52-week range. An incredibly rare strong buy from Seeking Alpha, 5 out of 5. Very respectable buy from Wall Street at 4.25, where we also see the forward P 21.5, little bit below historical 23. Yield, although fairly trivial in its own right, little bit above the 5-year. And on the blue tunnel, whilst we get a reasonable signal, it is pretty much right there towards the bottom. We did see Liberation Day, it slipped, although only slightly for a number of days, where when we zoom out to the last 5 years, this one always seems to be trading at a premium. Only now are we seeing it entering into a potential undervalued play, and they're expected to report their earnings in a matter of days, 29th of October, after the market close. And we can see their most recent quarter revenue was up 3%, so fairly trivial, around that of the inflation rate. Earnings per share on a diluted basis up double digit, but adjusted around 7%. And they're also projecting double digit growth to EPS over the next 4 quarters. They missed their most recent earnings and in fact have a 50% track record, although based on their growth into next year, forward P pretty much expected to drop bang on to 20, and their record also a little bit questionable. 5 out of 8 beats on the earnings per share, 3 out of 8 on the revenue, and if we look again at their most recent earnings per share miss, we'd have to go quite some way to December 2021. We are talking about an 8-cent miss. If we do the same for revenue, we can in fact notice they have missed quite a number of times, especially in the most recent period. One of the largest ones, in fact, was December 2023. And growth coming in at a B-. Well, revenue was up 5% last year, projected 7 this year, which is above the sector overall, although we're talking just trivial. Disappointing to see though, over the last 5 years, this one was growing around the 15% rate. Earnings per share projected 13%, slightly above the sector at 12 and slightly higher than their historical 12.1, with profitability at an 53% gross margin above the sector of 31, below their 5-year of 55, bottom line 28, well above the sector, but again we're seeing deficiencies. We want to see companies improve their margins. CP, at least in the more recent period, have seen it drop ever so slightly, but cash from operations, good to see that is up 4 billion from the 5-year average of 3, and institutions with their 72% ownership sold around 8 billion in the last year. They bought a little bit more at 10.9, indifferent in the most recent quarter, reverse of the trend though you can note in Q3 2024. And our intrinsic price, $81. Firstly, DCF, pretty much bang on the same value. You'll note we've used 12% growth rate, baked in is there or thereabouts at 11.3. Today for CP, we see a 5% MOS. You want 10, well, a buy at $73. You want 15 at 69, at 20, a buy at 65, and 25, 61. Wall Street fairly bullish, seeking alpha, an incredibly rare 5 out of 5. Well, Wall Street note $91 into next year, translating to 19% upside. So let us know your views on CP today, as well as the other stocks. Are they a buy, hold, or potentially complete avoid? And don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.